Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. It was a positive end to the trading week with both the S&P and the Nasdaq closing at record highs. The S&P 500 itself in new record territory, hitting that new high for the first time since February. And at the end of the session, all the major indices did end the day in the green. And we're learning how well equipped our banks are to deal with major financial downturns. We're going to have the latest data and break down what the bank stress test means for the economy at large and your investments. And getting a mortgage can be stressful, but there may be a new way to have an edge. Digital assets are moving into the housing market. The nation's largest mortgage finance firms will begin accepting crypto as an asset on loan applications. We're talking to a veteran mortgage officer to learn more about the implications. We got some breaking news to get to. Results from the Fed's stress test. They are out. And Yahoo Finance's Jennifer Schonberger is here with those results. Jen.
Josh, results from the Federal Reserve's stress test showed that 22 of the largest U.S. banks could continue lending to households and businesses during a severe economic recession with plenty of capital on hand to absorb losses from loans. Now, these results demonstrate just how strong the U.S. banking institutions are in our country and come on a week when the Federal Reserve and other financial regulators opted to propose changes to loosening a key capital requirement, with expected changes coming on the stress tests as well. Now, the stress tests were mandated annually by law after the financial crisis for banks with $100 billion or more in total assets. They examine how the banks would perform during a hypothetical severe recession to prevent bank failures in a crisis. This year applies only to banks with assets of $100 billion and above. Banks with assets of between 100 to 250 billion are subject every other year, and they were subject last year. This year, the hypothetical scenario, less severe than last year, envisions a severe global recession where unemployment spikes to 10%, home prices plunge 33%, commercial real estate plummets 30%, and the stock market plummets 50%. Under that scenario, all 22 banks in aggregate would lose more than $550 billion. Yet after covering losses, banks would still have capital left over equal to 11.6% of total assets weighted by risk. That is well above the 4.5% that the Fed requires. Now, the hardest hit area under this hypothetical scenario was credit cards, with losses amounting to $158 billion, or about 28% of total loans lost. The second biggest category was commercial and industrial loans, which would have cost $124 billion, or about 22% of total loans lost. Now, taking a look at how the nation's largest banks shake out, you can see all have capital that's more than double the Fed's minimum capital requirements. JP Morgan really leading the pack there with 14.2, well above the 4.5% the Fed requires. Now, taking a look at those mid-sized regional banks, including PNC, Truist, M&T, also above the Fed's requirements, but not quite as high as their larger peers. Now, I just want to note that the decline in capital under this year's stress test was actually a little bit less than last year, and Fed officials chalk that up to volatility in the models, and that is something that they want to solve for the stress test going forward. Fed officials looking at making changes to the stress test, expected to put out for comment the actual models that they use to cut down on the volatility. If they were to average results from last year and this year, banks actually would have stood to lose more capital, and that is something that they're seriously looking at, averaging results going forward. Now, banks are going to use this information to decide how much capital they want to give back to shareholders in the form of dividends and share buybacks. And Josh, we could see those results as soon as next Tuesday.
All right.
Back to you.
Thank you, Jen. Well, for more on the state of the banking industry and how to be positioned within the sector, let's now welcome in Brian Mulberry, Zacks Investment Management Client Portfolio Manager. Brian, it is great to see you. So we got the stress test, Brian. Now, as investors, we like looking at this, right? Because we want to see just how stable our big banks really are. What do you make of those results?
Yeah, really as expected. I didn't really see any analysts that were looking for any type of failures when it came to this stress test. I think the coverage ratio that was just shown was widely expected and known ahead of time. And I certainly agree with now this gives plenty of room for these banks to return capital to shareholders. So I would expect more robust dividend increases as well as share buybacks going forward based on the coverage that we just saw from the stress test.
In terms of Trump and his Trump-appointed regulators, Brian, I'm curious to get your take on this. They do want changes, lighten the capital, for example, that banks have to hold. I'm curious to get your take on that moving forward. Not everyone loves that idea, Brian. Democratic lawmakers, some consumer protection types. I'm curious what you make of it.
Well, I think it's certainly valid to have a stress test. The question is how much stress? As you just saw, a very severe recession was the model for this time around. And I think I understand where the regulators are trying to go here, and that's to actually have a more realistic probability. Is it likely in the next 5 to 10 years that we would see GDP drop by almost 8% in a very short period of time? Doesn't mean it hasn't happened before, and that there is a possibility that needs to be accounted for, but what's the real likelihood? And so trying to have something that might have different gradients, if you will, what a realistic recession would look like rather than the most severe outcome of all time. I think that there's some balance that could be achieved in tweaking the model to a certain extent. We want it to be realistic because obviously the administration wants to fund growth through these big banks. A little bit more liquidity, a little easier regulation allows them more capital to work with, where they could maybe ease out some of their lending restrictions, but they need to be thoughtful about the own risks that they're taking. In other words, who they're lending money to and what their expectations are for losses. So as we go through earnings season in Q2, we'll be looking very closely at what those measures look like, what each bank is telling us in terms of what their expected loss rate is. If there's a measurable increase there, then I don't think regulators are going to be able to close that loop and come in with some lighter suggestions. If everything stays the way that the stress test went and that they don't expect measurable increases in loss, then we start to see an opportunity here where they can come in and tweak the model a little bit more to the upside, if you will, a less stress test, and then go forward with better capital restrictions that are more pro-growth for the market going forward.
Let's get to some picks, Brian, in the sector where you say, listen, there's still opportunity here. This is a buy. JPM, walk me through it.
Just the scale of operations. This is the biggest bank on the planet. They have a great revenue generating machine that has multiple product lines with different customers. They had a surprise to the upside last quarter on the investment banking and trading fee side with a lower rate projected by the end of the year. Maybe not as soon as next month, but in next quarter for sure, we could see the net interest income picture improve for this bank. And they already have a pretty strong growth and expansion plan in place. We like JP Morgan a lot.
How about Citi?
Citi has done a great job reorganizing. They are in a completely different picture than where they were just a couple of years ago. They are one of the biggest, I think, beneficiaries of passing this stress test, but also reorganizing such that they're more productive with the capital that they have. Another winner in the net interest income category. They are in a great spot to raise their dividend and return capital to shareholders.
Another one, third one on your list here. I want to get your thoughts on PNC. Which has had, I'm just looking, it's had a pretty good run over the past 12 months. I want to just get this right, Brian. It's about 20%. What moves it higher?
Yeah, absolutely. I think there's an opportunity here for some of these bigger regional banks to step in and be a little bit more competitive and serve some of the segments of growth in this economy that are looking for capital, but haven't been able to break into some of the big banks and get approvals on some of these loans. So there's an opportunity here for PNC in particular, especially with investments that are going to be made in their backyard in Pittsburgh with the U.S. Steel merger with Nippon. There's an opportunity here to capture some capital that's in motion and an opportunity to compete with some of the bigger banks. Yes, they've been rewarded in terms of the share price, but I think it's well-earned growth at this point. They've been a really good steward of their capital in the balance sheet, reducing risk, driving out returns for shareholders. This is a good name for us.
Brian, appreciate your time, those picks. Thank you, sir.
Thank you.
Stick around. Much more As for Trends still to come. Automakers keeping a close eye on tariff developments. U.S.-China trade deal optimism boosting spirits as the European Union and U.S. work on a trade agreement. Here to discuss the rocky terrain for the auto sector. Let's bring in Allison Worldwide Managing Director Rebecca Lindland, as well as Yahoo Finance's senior reporter Pras Subramanian. Pras, start us off.
Yeah, Josh. So, we're looking at some trade deals potentially happening. The EU and the U.S. hoping for a deal on before July 9th, before that the tariffs are continue on with for auto tariffs of 25%, 50% for aluminum and steel. That's a big problem for the sector. So hopefully they'll get a deal there. But it's not all sort of, the details come later, right? So in the UK and the US agreed to a deal, or 10% tariff deal, but a lot of these companies, in a week ago, but a lot of these automakers are still waiting to hear details. We're probably going to see those on Monday. Apparently, Monday will be the official start of this. So good news for them. But companies like Bentley, the CEO told me they stopped all exports. So did Jaguar Land Rover. Aston Martin says that they will now continue to export based on that 10% tariff rate. So you're seeing a little bit of certainty there. But Josh, I guess what it means is that a deal is struck. You may not see the actual details for weeks to come.
Who would be, just quickly, Bryce, who would be on the radar, potentially taking some tough hits here?
In the EU, it's the German automakers, right? It's the guys that build a lot of cars in Germany. Now, BMW and Mercedes, they do build some SUVs in this country, but Porsche, for instance, they don't build anything here. Audi, they build in Germany and places like Mexico, which is affected by tariffs. So that's why there's a lot of hand-wringing here and a desire to get a deal done before that 9th date.
Rebecca, I want to bring you in here as well. My buddy Rebecca Al Root over at Barron's, he kind of puts it like this. He said, what does Trump want? He wants an all-American car, including the parts. And he is willing to toss in some big tariffs to get one. So as a longtime watcher of the industry, Rebecca, how does the industry, how do these auto companies navigate that?
I love the concept of building where you sell, but the reality is this industry, it's like trying to move the Titanic. Like, it just doesn't move that quickly. And these production, I used to do production forecasting. It goes out 7 to 14 years. Like, these things are put in place. We have seen some positive moves. General Motors, for instance, is reallocating from Canada into the US on some pickup trucks. So they are trying to do their best. As Pras mentions, BMW and Mercedes basically build all their SUVs for the rest of the world, except for China, here in the States. So they are, interestingly, not vulnerable from an SUV standpoint, but highly vulnerable from a sedan standpoint. So every manufacturer has a little bit of a different story.
How do they navigate the terrorists, Rebecca? What's going to happen? They eat that, they pass it along to Rebecca and Josh, some combination?
It's really a combination. Right now, vehicle prices are nearly $49,000 on average for a new car. And just 5 years ago, it was closer to $35,000. So we are still seeing a lot of challenges. Consumers are moving to used cars, but there's not a lot of good used cars out there because the market has really been stymied. We've been at about 15 million for years, and we really expect it to be closer to 18 million for new car sales. That then in turn feeds used car sales. So what the manufacturers are trying to do is mitigate. They're trying to potentially renegotiate some contracts with suppliers, which then puts more pressure on the suppliers. And they're also trying to do better deals like employee pricing to get consumers back into the showroom.
Pras, you've done some reporting recently on where prices could be heading. What did you learn?
Yeah, so Cox Automotive had their mid-year review and second half look ahead, and they were talking about how tariffs are actually going to be an inflationary effect on prices. In fact, they're already seeing it happen as inventory comes down. Higher expensive inventory gets replaces the tariffed inventory, right? And then you have stuff like supply shortages, things like that have always been part of the industry. You're going to see more higher prices, and that could actually bring down that seasonally adjusted rate that Rebecca mentioned to 1.2% or so, down to in the low 15s, mid to low 15 million. So that's not where you want to be when we're seeing before, 17 and a half and potentially 18 would be a huge year. But we're seeing a lot of depressed sort of auto demand because pricing might increase more in the second half this year.
Rebecca, we did see folks, they kind of rushed out. They bought those cars, try to get ahead of the tariffs. Would you expect to see some give back in the months ahead? What does normal sort of look like here in terms of buying patterns?
Yes. Well, so Allison Worldwide is part of Stagwell, and the umbrella of companies. One of the access that we have is to Harris X, and Harris X and Allison Worldwide recently did a poll. We've actually done it the last 3 months to test consumer sentiment and how people are feeling, and we're actually seeing improvement, which is great. So about 20% of Americans are now saying they're considering buying a new or used vehicle this year, and that's up for 17% in April. So that will help. I don't know that people necessarily delayed purchases or just weren't really planning on it. The 20% is pretty neutral. About 5% of Americans buy a new car every year. So I think that we're actually trending okay. Again, it's just what they can afford. They are expecting vehicle prices to increase about 9%, which again tracks in line with what we're seeing. But consumers expected vehicle prices to increase by 14% just a few months ago. So everything is trending better. It's just still not that great, frankly.
Rebecca, Praz, great to see the both of you. Thank you.
Thank you so much.
Stick around. Much more Ask for a Trend. That's still to come. Crypto will now be making itself at home in the mortgage sphere. The nation's largest housing financing firms, Fannie Mae and Freddie Mac, will start accepting the digital currency as an asset on mortgage applications. It's another big step by the White House to help bring digital assets into the mainstream. I'm joined now by Jennifer Beeston, Executive Vice President of National Sales at Guaranteed Rate and a veteran mortgage loan officer, nearly 2 decades of experience. Welcome, Jennifer, to the show. So this does sound, Jennifer, like at least potentially a big shift in our housing financing market. I'm just curious what you make of it.
I think it's delightful. It's going to help more Americans become homeowners. Right now, you can use crypto when you're buying a house, but it has to be liquidated. So for down payment, it has to be liquidated. For reserves, it has to be liquidated. What Pulte has called for, and this isn't effective yet, but he's called for Fannie and Freddie to look at how they can use it as reserves without liquidating it, which is critical because every crypto person I know never wants to liquidate it.
Jennifer, I'm just curious, though, why traditionally, and you've been in the business a long time, would crypto have been excluded from underwriting frameworks? I mean, traditionally, was it because folks thought, listen, it's too volatile, there's not enough regulation? What were the reasons?
I think that the mortgage industry often moves slower. I also think that in the grand banking sphere, there were quite a few naysayers against crypto, saying it wasn't real money and it was a fad. But as we've seen with BlackRock doing a crypto ETF, Chase is now looking at using Bitcoin ETFs as collateral on loans. The sentiment's really changed. And I think that's what's driving this, as well as the president coming out and saying he wants the United States to be the crypto capital of the world.
The actual effects of this, Jennifer, let's say it happens, would you imagine, okay, there's going to be just that many more potential hopeful American home buyers who are going to be able to qualify for a loan?
Yeah, I think we're removing more barriers. In terms of reserves, a lot of people don't understand that in situations like, let's say it's an owner-occupied loan, sometimes if you have a higher debt to income or something's not quite right, more reserves can help get that loan approved. I can have a borrower right now that has $100,000 in crypto, and unless they liquidate that, I can't use that to strengthen them. So Fannie and Freddie looking at a way to do that, it will help people.
Do you think, Jennifer, though, let's say the price of the cryptocurrency falls, would that mean a lender would go back to the borrower and say, hey, you got to put up additional collateral here?
It depends. If the loan has not closed yet, yeah, we would be paying attention to that theoretically, but we still don't know what the guidelines and guardrails on this are going to be. Are they going to treat all crypto coins the same? Or is it going to be something like only the, Bitcoin, Ethereum, Ripple? I think Trump said there were about 5 that he was looking at the United States investing in. Is that what they're going to be tying it to? We don't know what the rules are going to be yet, so it's hard to understand the risk. And that's what they're studying, is how to do this in a safe manner and still help people get into homes.
One question I've heard asked, Jennifer, I'm curious to get your take on this. I've heard some people ask, you have this sort of established mortgage system and how tough it would be to integrate crypto into that, just tactically and operationally. What do you say to that?
I think that what they're talking about right now is more just underwriting. So I don't think that's difficult because it's just going to be, we saw this with restricted stock income. We saw a lot of that in the tech sphere. It's just the way we look at it. Now, if, for instance, you started seeing that down payments, instead of being liquidated from crypto, people were expecting to have that go from the exchange straight to escrow, yes, that would be a change. However, there's companies in that space lining up to do that. So I think tech is moving so fast right now. This isn't the mortgage companies of years back.
Jennifer, great to have you on the show today. Thanks so much for joining us. Appreciate it.
Thank you. Appreciate it.
Time now for What to Watch. We're going to start off on Tuesday when Constellation Brands reports first quarter earnings after the market close. Analysts expecting an adjusted EPS decline of 5.6% year over year and a 3.4% in revenue. The beverage company stock has been down 27% year to date, namely due to President Trump's tariff policies and the uncertainty impacting imports and exports. On Wednesday, Tesla set to release its second quarter vehicle delivery and production information. This comes as the company faces weakness in sales domestically and abroad in Europe, with CEO Elon Musk firing VP of manufacturing operations as a result of the slowdown. On Thursday, the June jobs report will release an hour before markets open, with analysts expecting the non-farm payrolls to have added 110,000 jobs. Estimates of unemployment a tick higher at 4.3%. Finally, on Friday, July 4th, the self-imposed deadline to pass President Donald Trump's big, beautiful bill set to expire. Senate Republicans are racing to meet that deadline, drafting revisions and holding difficult conversations about provisions to get the bill passed. This comes as a central part of that bill surrounding Medicare was determined to be improper procedurally, according to the Senate parliamentarian. Now senators are racing to revise and pass the bill back to the House before Congress's summer recess takes hold. Well, that's a wrap on today's Ask for a Trend. Be sure to come back Monday at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.